Need to check. Okay. Please, where did you stop? Where did we stop? Can someone just remind us where we stopped in our previous class, please?
Illustration 3, Lekki Piers Limited.
Okay, that's fine. That is where we stopped in our previous class. Okay, that's fine. I think I've seen it. Please confirm, can you see my screen clearly?
Yes, sir.
Okay. So that means we are good to go. Right. So that means we are good. We are good to go. Okay, Blessing, I'm seeing your hand up. What happened?
Good evening, sir.
Good evening.
Please, I wanted to confirm if this note is on the drive because I can't find it.
It's there now. This is there. It's actually there. This is
The last one me I'm seeing on my this thing is agency theory.
no, it's there. This is capital budgeting. This is capital budgeting. So did you check? Did you search? Do your search and check capital budgeting. You will see it.
Okay,
Yes.
thank you.
Yeah, okay. Okay. So any other question? Are we good? Okay. Okay, that's fine. So it means we are good now. Right, it means we are good. So now, if we can remember what we did in our previous class, and there's a little bit, let me quickly clear. Let me quickly share more light on something here, so that when you see it going forward, it will not look like a magic. Right, it will not look like a magic. Plus, capital allowance is usually in tax. You can only claim capital allowance when the assets is being put to use. When the asset is being put to use, right? Meaning that it is like the year you start using the asset. But theoretically, if you want to look at it theoretically now in project finance, in this question, we should not equally forget in tax. Your initial allowance will give you the lifespan of that particular asset. We give you the lifespan of that particular asset. Now, we have 20% here on the asset. And this is plant. On the norms, in tax, plant class, on the norms in tax, plant is for how many years? Is it 4 to 5? Is it 4 or 5 years? How many percent?
5 years.
20%. 20%.
20%. Now, That is the reason why.
Approximately 5 years.
That is the reason why they gave us 20% on the reducing balance, meaning that the company should enjoy capital allowance for 5 years. But unfortunately, our project is not up to 5 years. What can we do? And that is the reason why we start our capital allowance from year 0. For the company to enjoy capital allowance for 5 years, the project is for 4 years, we know. But therefore, it has to start from year 0 to complete the 5 years. Right? And that is the reason why we started from year 0. In another case scenario, additionally, we have here to be the realizable value should be after 4 years. That is when you will now know that this thing is not excuse me. This thing this your capital allowance will not be for the 4 years because it is after 4 years. You can't do it up to 50 year because the project is just for 4 years. That is why we now say, oh, if that would be the case, we have 20% and you have the realizable value after 4 years. So therefore, for us to complete the 5 years, of course, we can't expand because we want to enjoy capital. We can't expand. The lifespan of the project is just 5 years. It's 4 years. So therefore, we now say, okay, year 0, we assume that, okay, year 0 will be 1, this will be 2, this will be 3, the other one will be 4, and the other one will be 5 years with that. And that is the reason why we start from year 0. It is not in all cases, but you just have to look for, in the question, check the capital allowance given to you, right? And when you look at it, oh, this capital allowance is for how many years? Oh, usually it should be for 4 years. So therefore, you have to do it year 1, year 2, year 3, year 4, if the project is just for 4 years. And that is why we did it like that in our previous class. Now, the first requirement is on tax savings, which we've solved that on tax savings. We've calculated that. The second requirement is to determine if the project is worthwhile. Then the C part of the question, show what difference it will make if the plant were to purchase and sold at the beginning of the accounting period. Comment on the wisdom of disposing of the asset on the first day of accounting period. Class, don't forget that they've said they want to dispose these assets after 4 years. They are not saying that it is not after 4 years again. Let's make it at the beginning. Not after 4 years. Now it's at the beginning. Meaning that it will be at the beginning of what? Of year 4. Class. They now say that, oh, show what difference it will make if the plant were to be purchased and sold at the beginning. Just the part of the disposal. Just the part of the disposal of it. And before you even dispose the asset, class, before you even dispose the asset, you've been enjoying capital allowance on that asset. You've been having tax savings on that particular asset. Now they say at the beginning, that is at the beginning of year 4. So if it is at the beginning of year 4, right? If it is at the beginning of year 4, it means that this our year 0, we will not have year 0 anymore. So it will just be from year 1 to year 4. Let me come again. The question says, show what difference it would make if the plants were to be purchased and sold at the beginning of the accounting period. Meaning that It is not at the end. It is not after. It is at the beginning, which means that at the beginning, when you will sold, when you have to sold, when you have to purchase and sold at the beginning of the accounting what? At the beginning of the accounting what? Period. We cannot say, oh, you purchase this asset year one, you now sell it when project is for 4 years. It is not possible. What it means is that at the beginning that is here, it means that at the beginning of year 4. Now, what we just need to do is to compare what we have when they dispose the asset after 4 years. That is 5 years, tactically, right? And we'll now compare when it is exactly 4 years, and we'll just look for the difference. So now just pay attention and observe. Rejoice.
Okay, thank you, sir. My question is this like this particular question that we're doing, they changed the rule of the capital allowance to 500. What's in another question? The asset is to last for 4 years, and then that's like the project 5 years, then the asset is not 4 years. I was going to start moving to 5 years. I'm sure like this one is not outside from zero. I don't know if you understand my question.
I don't understand though.
Okay. Like this one, the capital allowance is 20%, meaning we're supposed to do the project in like 5 years. But then the question said this project is going to last for just 4 years. And that's why we started from year zero. Now, I'm not asking what if in another question that capital allowance is for actually 4 years, but the
You
project
start
is
from
now
year
5
one.
years. What are we going to do?
No, the project cannot be 5 years. The project cannot be 5 years when the capital
Okay.
is 4 years. Do you understand?
Okay. Okay.
You understand? So, unless if it is for 4 years, which means you have to start from year 1, year 2, year 3, year 4, year 5. So that's it.
Oh,
Thank you.
okay.
Yeah.
Okay. Thank you.
So it is just the part of, don't forget, they are just talking about plants, right? They are just talking about the plant. And the plant that we are talking about, you've claimed a tax savings on that particular plant. Now, we need to go back to what we did. Let's quickly do a rough walk. I'm coming. This is for A, B. This is C, right? Okay. So what we need is just the part of the capital allowance where we have a savings. So we don't need any other thing. So let me just pick this part. Let me just pick this. I'm coming. So it's a very technical. If you don't, yes, I think we did something like that for in SFM, where I have to explain to them that you just have to observe the question very well, right? That is why they will say attempt. So they don't expect you to score to have 15-15 or 20-20. So they will just hide something. They will hide something that you need to unlock it. Understand? You need to unlock it. So okay, let's change the pattern. Let me change the pattern. Coming. Okay, let me change the pattern to be. You have to suspend all your questions. Yes, I need to solve one question there before we move on. So you leave everything, maybe doing intensive, you can ask your question or as we move. So, I want to change the pattern. So now, in the first case scenario, we've done when it is after 4 years. right? And this is what we have. Now, in the second scenario, they now assume that, oh, let's assume that you bought this asset at the beginning, not, oh, excuse me, not after 4 years. Now, if it is not after 4 years, if it is at the beginning, it means that it will just be for 4. So, meaning that the tax savings will not start from year 0. It has to start with what? Start from what? Year 1. Listen, oh. Now, they say it is at the beginning. Let's assume it is being bought, purchased, and sold at the beginning. At the beginning, not after 4 years anymore. Now it is at the beginning. Is that not so? So meaning that it is at the beginning of year 4, not after again. We should not equally forget that this figure here, this 4 year, is at the end of year 5. We should not forget that this is at the end of year 5. But now they say it is at the beginning, meaning that they want something that will just be like 4 years, not after 4 years. So our tax savings will actually change. It will not start from year 0 anymore. We have to start the tax savings from what? From year 1, right? We have to restructure that part. We have to start the tax savings from what? From year 1. So therefore, now let's check something out. So this will be from year 1. We have 250, 200, 160, 128, right? 128. We need to go and check our capital allowance again. Okay, so that we will not mix it up. Just a minute. We need to check our capital allowance again. Okay, that's fine. Let's bring it down. Let's bring it down. So let's start. I have to drop this, right? So this will start from year 1. We will have 1 million. We will have 1 million. So this will be 4 million. And I'm supposed to even quit. What should I even do itself? Okay. You guys should just give me a figure. So 1 million. So this will be 250,000. So here we'll have 5 million. Excuse me. So we'll not have a 0 anymore. So we can have this. The tax sitting down value. Let me just say this will be year 2.
Sir, you could just change the dates.
The dates are we?
The numbers, so that it's faster.
Oh, no, just wait.
That's number. Yes, you just change it to 0 to 1 to 3.
Okay, that's fine. I'm coming. This should be 4 years again. Okay. Let's slow down. So here we have 4 million. Then the capital allowance is 20%. Right. So what do we have before here? What is the 20% of this?
800,000. Let's just do it like that. I have the figure.
800,000. Okay, that's fine.
Yeah.
800,000. So this is 800,000.
That's right.
So 25% of this, what do you have?
200,000, yeah. For year 2.
200,000.
Yes.
Year 2. Okay.
And we have million.
What is the difference?
3.2 million for year 3. Tax return value.
Okay. Okay, that's fine. And
I think it's correct. correct like this. No, but year four.
Yes.
Year four.
Yes,
We
I
have
know.
to start sitting down value of 2,560,000 naira.
60,000, yeah. So
We now add scrap value
we
of
have scrap value.
with
Thank you.
balancing allowance
So what is the scrap value?
0. No scrap
Okay.
value.
Okay. Thank you. That makes sense. 0.
Yeah,
So we have balancing allowance, right?
that's right.
Allowance. So we have 2,560,000. So this is 2,560,000. So what is the tax saved?
640,000.
Okay, 640,000. This is 3. 640.
Ah,
640,000.
yes, that's right.
So what do we have here?
Year four. Ask for 4.
Okay. So before. Okay. Excuse me. So 250. Please confirm if these are correct. 250, 200, right? 160, right? And this is what?
640,000 for year 4, yes.
640,000. Okay, that's fine. So um so we have 250. After 250 is what? 200,
Yes.
150,
160.
and 640.
Yes.
640. 640. Is that all? Okay. Is that
That's right.
all?
Yes.
Okay, that's fine. So what do we have here? If you multiply this times this, what do you have?
We have 2,269 naira. 2,260. Okay, 2,315. I mean, sorry.
2,000,
315.
2,315. What do you
Yes.
have here?
We have 2,100.
2,100. What do you have here?
723.
743. What do you have here?
723. 723, sir.
Yes, 743.
23.
Okay, 23.
Yes.
So what do you have here?
1,022.
1,022. So what
Yes.
is the MPV?
That should be
So year
I'm
0 should
coming.
be 5,000.
5,000. Yes, it should be 5,000, sir. While
Okay,
yeah,
I'm coming.
there are some corrections on your tax savings.
Okay.
Yes, we are adding now. We are adding cash after tax, cash profit after tax plus tax savings.
Yes, plus tax savings. Did you add them? Did you add
Not
the cash profit?
yes, we've done it, but your figures are not correct.
Okay, I'm
So
coming.
from year
I'm
one, it should
coming.
be
Just
500.
hold on.
Yes, sir.
Just hold on. Okay, for year 1, we have 250 here.
2,000,
Is that it?
2,500 total.
Okay,
500.
2,500. What do we
Yes,
have here?
2,450.
2,450.
We
What do we
have
have here?
910.
19. What do you have here?
We have 1,262. Okay, 1,390. Sorry, I'm just 390. Yes,
1,390.
yes. So the present value of that should be 5,000. While our MPA will be 1,116 naira.
Equals to 1,000,000.
116 naira.
160,
Yes,
right?
160, not and 60. 1,160.
Okay,
Yes.
160. Okay, that's fine. Okay, now what is the difference? Because the question says we should comment on the difference. Show what difference to make if the plants were, what is the difference? So we need to check.
49,000, sir.
So the difference is 49,000. Of difference. The old one is what? 1 million minus
1,207.
160. So what do we have?
49,000. Yeah.
49,000. Yeah, that is what we have here. So my point here, right? I mean, bring a similar question like this, maybe then when we start this thing, right? Now, you just need to understand this is 4, this is 5, this is 3, and the last one is what? The 8 marks. So if this is at the beginning, so if this is at the beginning, where it has to do B, it starts to, we have to calculate it at the end of what? At the end of year, at the end of year what? At the end of year 4, right? So this is just 3 marks. So the next question is, explain the meaning of the net present value and internal rate of return measures. Outline the major comparative advantage and the disadvantage of the two methods for the appraisal of the independent project. Class, don't forget that you have these notes. You have these notes, right, of the net present value and internal rate of return. Outline the major comparative, which one has advantages, as well as what the advantages for the appraiser of independent project. Class, what is independent project? What is independent project, class? Am I the only one in this class?
A project that can be done on its own.
Okay, that's fine. That is an independent project. And to what extent will the two methods give the same accepted or rejected signal for the independent project? What you need to do is that explain what is net present value. Then talk about the decision. Explain internal rate of return. Talk about the decision. Talk about the advantages and the disadvantages. Right? That is why they say to what extent will the two methods give the accept or reject. So in the MPV, you say it should show a positive MPV. In internal rate of return, you say the internal rate of return should be higher or to be greater than what? The cost of borrowing. Right? So it is what it is, class. Can we move? Can we move?
Moving on, sir. You can move, sir.
Tolulope, can we move? Rejoice.
Yes, sir.
Who is against me in this class?
Nobody can be against you, sir.
Okay, according to you. I'm trying to look for a question that we'll do. Okay. Please, let's quickly check. We have examined, I still remember question on discounted payback period, right? I think I mentioned it. We've not done discounted payback period, right? We'll do it. We'll just pick one of these questions and use it for discounted payback period. Class, are you still with me?
Yes, sir.
Okay. Am I too fast? Am I too fast, class?
No, sir.
No, sir.
Okay. That's fine. So can someone read the requirement of this question?
Calculate the net present value of the planned purchase of the new machinery using a
Wait.
nominal money term approach and
Madam,
comment on it. Sorry.
madam,
Bye bye.
madam. Madam, you are using a bedroom voice. Eh?
Oh, sorry.
So,
Sir, question what?
yeah,
Sir,
question.
let's guys let
Let
the
me
guy
read
read
it.
this thing, sir.
Nalayo, which guys?
Wait,
That
wait.
one a voice. No. I beg. This is evening. You know, you need to hear some kind of sweet voice. Not so I think
Let the guys
question
breathe small, sir.
illustration 12. Illustration 12. Are you there? Required.
Hey,
Calculate the net present value of the purchase of machinery
Even your network,
money terms
Miss,
approach.
Miss, your network. I can't even hear you.
D.
Hello.
Okay.
D.
Required.
Sorry.
A. Calculate the net present value of the planned purchase of the new machinery using a nominal, that's in bracket money terms, approach and comment on its financial acceptability.
Hold on.
B.
Just hold
Discuss the difference
on.
between.
Now, thank you. Now, the first requirement says that calculate the net present value of the planned purchase of the new machine using a nominal, meaning that if you are using a nominal term, the cash flow must be in nominal. Is that not so? The cost of capital must be also be in what? Must also be in money term. And comment on this. B. Discuss the difference between the nominal approach and real approach to calculating NPV. Please, when you want to explain this thing, explain in details. This is 6 marks. Don't joke with it. Explain what you know about money. Explain what you know about real cash flow. Then you explain, you tell them that money is for money cost of capital, real is for real cost of capital. In fact, give them the formula. Class, am I communicating? The difference, give them the formula as well. Identify 2 listed company such as Incas and discuss how each of these financial objectives is supported by the planned investment in new machinery. What is the objective of a listed company? Financial objective. Remember that we did something like this at the beginning of financial management. What is the objective of a financial objective of a listed company? They now mention the name, one of the name of the company that we are working with now, which is Inca, and discuss how each of the financial objectives is supported by the planned investment in new machinery. Class, financial objective. D, from the point of view of shareholders, what are the major limitations of restrictive covenants often used by bond holders? Interesting. I think one of the notes I sent to you, you will see the reason why there is a conflict of interest between the bond holder and shareholders. Did you come across such notes in my in the drive? Did you see anything like that, class? Away.
It's under agency theory.
Yes, it's on. Thank you. It's under what? Agency theory. Okay. Oh. Now, the first one that is, I'm concerned about just the first and the second one. You see, the C and D, you have the notes. We'll look at, we'll discuss it in class together though. Now, Inca PLC is a listed. You can see Inca is a listed company. That is why they say financial objective of a listed company. What is their financial objective? Which plans to meet increased demand for its products by buying new machinery cost. This is the new machinery costing 5 million. The machinery would last for 4 years. Can you see it? The machinery will last for how many years, class? Will last for 4 years. At the end of which it will be replaced, meaning that they will replace it at the end of that particular year. If the machinery is to last for 4 years, which is just 4, then at the end of which it will be replaced, the scrap value of the machine is expected to be 5% of the initial cost. Meaning that at the end of the year 4, the scrap value, you can see that they say it is at the end of which it will be replaced. Meaning that at the end of the project, it will now be replaced at the end of year 4. Then they say, okay, there is no project. We are done with this project. Let's everybody go. So they will now have a scrap value, 5% of the initial cost. Now, capital allowance would be available on the cost of the machine. Capital allowance will be available on the what? On the cost of what? On the cost of the what? On the cost of the machine, right? On a 25% reducing balance basis. You can see now, because the asset will last for 4 years. So they will not claim capital allowance for 4 years. Year 1, year 2, year 3, and year 4. With a balancing charge, with a balancing allowance or balancing charge claimed in the final what? In the final year of what? In the final year of what? Operation. Right? This investment will increase production capacity by 9,000 units per year. And all of these units are expected to be sold as they are produced. Meaning that because they have this machinery now, it will not be increasing their production by 9,000 units per year, because as a result of what they have as machine are expected to be sold as they are produced. Of course, when you produce units, you have to sell it. Relevant financial information in current terms is as follows. When they say something is in current terms, what does that mean, class? They say something is in current terms. They say something is in current terms. It means what, class?
The present value.
Present value. What is present value? I don't know.
Real cost of capital.
Current market price.
The fair value.
Rita.
At the end of 4 years.
I think maybe it has to do with maybe the contract year or so.
Is the money cash flow?
Yeah. The current terms of the asset liability
Is at the beginning of the project. At the beginning.
They haven't removed inflation.
Okay. Forecast inflation. Selling price is 650 naira per.
Answer the question, no.
Yes, so we've not answered the question. Let's do the correct thing to know if you're right.
The selling price is 650 naira per unit and is to be inflated 4% per year, and the variable cost per unit, meaning that 1 unit will be 250 per unit, and they have capacity to have 9,000 units. Incremental fixed costs 250 per year, and we have to inflate it. We have to increase it per year. Year 1 we increase it. Year 2 we increase it. Year 3, year 4, year 5, year 4 up to year 4. In addition to the initial cost of the new machine, initial investment in working capital of 500,000 will be required. Now, this question will test your knowledge on inflation as well as how to determine the working capital. Investment in working capital will be subject to the general inflation, which is expected to be 4.7% per year, meaning that for you have initial investment in working capital of 500,000. So per year, you have to increase it by to be 4.7% per what? 4.7% per year. Income pays tax on profits at the rate of 20%, meaning that on 1 year in arrears. It means that the tax of year 1 will be paid in year 2 because it is in arrears. The tax is being paid in what? In arrears. So the tax of year 1 will be paid in year 2. The year 2 will be paid in year 3. Year 3 will be paid in year 4. Year 4 will be actually be paid in what? In year 5. The company has a nominal money term after tax cost of capital of 12%. This is the money cost of capital. So definitely we will use money cash flow to discount. You use money cash flow for money cost of capital. Now I'm now asking the relevant financial information in current price term is as follows. What does that mean? If they say something is in current terms, current price, what does that mean?
So it means that it means
In
that
real
it
time,
is in real
Market
terms.
price.
So we have to convert it. We have to convert it to money cost of capital when we are solving the question.
It is not money cost of capital, money cash flow, money cash flow, money cash flow.
Sorry, money cash flow. Those terms.
Right? Now, it means that these are in current terms. These are in real terms. If they say something is in current price terms, it is in real terms. Right? It is in what? Real terms, without the effect of inflation. And that's the reason why they give us the forecast, what is it called? The forecast inflation to be 4.0 per year. Excuse me. And 5 points, 5 point this per year and 5 points per year, right? So what is the name of the company first? There is capital allowance, right? Let's establish that. Then if we've established that there is capital allowance, we can do our workings by increasing our selling price per year by 4% per year. So let's start from the revenue workings before we do the computation. Let's say revenue So what is the selling price? What is the selling price of what is the units? The unit is 9,000 units. So what is the selling price per unit? What is the selling price?
650.
650 naira per unit. And it will increase by what? How many percent?
4%.
4%. That is what? If it is 4%, it will be 1.04 raised to power of 1. It's going to be increasing on year basis. So this will be year 1. So we can have this. There are two approaches to this question, right? But let's just be consistent. Let's use this approach. So the next one is, don't forget that it will be increasing on year basis. Times 650 times 1.04 raised to the power of 2. Inflation is 1 plus inflation rate raised to the power of the numbers of years. If it is per annum, you will see they will tell you that per year.
So can we give the answer?
Right? No, I'm coming. Just hold on. Oh, that deletes that. Coming. Please, are we still together? Are we still together, please?
Together, sir. Yes.
Why is this thing jumping? Okay, year 3, 9,000 units times 650 times 1.04 raised to power 3. So year 4, 9,000 units times 650 1.04 raised to power of 4. So what do we have here?
6,084,000. 6,084,000.
6,084,000. 6,084,000, Abi. Oh, okay, 084, right?
Yes, sir.
So what do we have here?
6,327,360.
6,627,000.
327.
Okay,
327. 360.
Okay, 360. What do we have?
6,580,454.
580,000
454.
454.
What do we have here?
6,843,673.
673.
Okay, just hold on. 6,043,000
843,673.
673, right? Because it will increase by 4% per year. And if you want to do the increase, you have to follow the inflation. 1 plus inflation raised to power the numbers of years. So it will increase by 4% per what? Per annum. So having increased our revenue, what else do we have? We have variable costs. But before we continue, do you have anyone that have question? Variable costs. Variable costs. If you have question, you can unmute your mic. Variable costs.
Yes, I have a question, please. Sorry, sir.
Okay, go ahead.
I'm really sorry. From the beginning of the lecture, I joined, but what is going on? I don't know. I'm lost totally. You know, from the explanation, I was trying to get the explanation what we are trying to say, but I didn't get it. So it's true I'm here, but I'm not following. Just want to express myself. Sorry. Thank you.
Have you watched the previous lecture? Have you been following our classes on capital investments or investment appraisal?
Capital budgeting, yes. Capital budgeting, yes. I was in the last lecture. I have it here. I followed in calculation.
No, it is not. It is not to be in the last lecture. Like, did you check? Did I talk about inflation? Have I talked about something like this before? Do you have the question first? Let's start from that side. Do you have the question with you?
No, I don't have any question with me. I'm relying on what you are reading.
No, there's no how
from the screen.
That is okay. Okay, that's fine. This is where we pick it from. It is to increase by 4% per year. Can you see it? Can you see it?
Go ahead.
So
go ahead. Sorry, just go ahead.
If the revenue will be increased by 4% per year, Annie.
So I have a question. Please, my question is if you can throw more light on this current price term that you explained.
I've done that before. I can't explain it. I'm sorry. I've done that before. Thank you. Can go back
Okay,
to.
so I have a question.
So what is that?
Okay, from the question, they said the selling price would increase 4% per year. So from the calculation we started with, inflation, or I mean, you started the increment from year one. I was thinking year one would be the normal price, then year two would now increase.
You see, you will not don't interpret questions like that. So, means if the question did not tell you that year one will not be this, don't interpret the questions like that. It is in the question that will tell you that year one will be in this price. Then you will know that from year two, you start inflating it. Do you understand? They say it is per year, year one, per year, year two, per year, year three, per year, year four. Do you get?
Okay, sir. Yes, sir. Thank you, sir.
You're welcome. Thank you. So, variable costs. So what is our variable cost? Variable cost will increase by what? 5%, 5.5%, right? Variable costs times, what is the variable cost per unit?
250 naira.
250 naira per unit times, and it will increase by how many percent? 3.5%.
5.5%.
That's 1.055.
1 point what?
055.
Okay. So you raise it to power of 1 for the first year, it will still be the same figure, right? So what do we have? Okay, what do we have here?
2,373,750.
2,373,750.
2,370 what?
373,750. 373.
750. Okay. Like I said, there are two approaches to this, but I always want to use this so that next time when you see something like this, you will know how to do it. But I will also show you the second approach. So this is raised to power of 2. Right, this is raised to power of 2. So what do we have here?
2,504,306.
Okay, 2,000,000 5 what?
504
504
306.
306. 9,000 units. 9,250 times 1.055 raised to the power of 3. What do we have?
2,642,043.
043. Thank you. In the last year, we have 9,000 units times 250. 250 times 0.55 is to the power of 4. So what do we have?
2,787,355.
355. This is the variable costs. Right. This is the variable cost. Then after that, we have incremental fixed costs. You can see, don't forget I said what is relevant. Fixed cost is relevant if it is incremental or if it is specifically. If it is specifically for the what? For the what? For the projects. Right. And we have incremental fixed costs to be this per year. So we need to increase it per year so we can have incremental fixed costs. Right. So what do we have there? We have 250,000, right?
Yes.
250,000 times 1 point. What is the percentage? Increase by what?
5%.
1.05 raised to the power of 1. If you don't know how we arrive at 1.05, you can omit your micro. So what do we have?
262,500.
You don't understand. Who is that? Sorry.
It's me.
You don't understand. Which one you don't understand?
You say 1.05 raised to power 1. Sorry, I came late.
Right.
Mm.
You do what? You came late now.
Yes,
right?
sir.
You came late. Right.
The videos are on YouTube. Can you go to YouTube and watch the videos after the lectures?
Inflation rate. This is the formula. If you check the material, is also there. Right. When you are increasing inflation, you're welcome. When you are increasing inflation per year, it is 1 plus inflation rate given to you. Right. Raised to power of that year.
Okay.
Right. Per year. They say it will inflate by year by year, year by year, year by year. So you have to be increasing it by the percentage.
Okay. Thank you, sir.
You're welcome. So what do we have here?
262,500.
262,500. Right. We have Kudus, are you still in this class? 1.05 raised to the power of 2.
Yes, sir.
Okay, that's fine. What do we have here?
275,625.
275,625. Okay, year 3. 250 times 1.05 raised to the power of 3.
28940.
406.
Two what? Sorry.
289,406.
289,406. The last year, 250,000 raised to the power of 4.
Three zero three 878.
303
877.
877 or 878.
878.
877. 877.
877.
877.
877.
Okay, so that's fine. Now, we've increased all the variables according to the question. We don't just start to increase on year. It is the question that says this is their forecast inflation, right? So we are done with this part of it. So we can either we move to our capital allowance so that we determine the tax savings. Please, who is that? You can mute your mic so that we move from there to
Hello,
where?
sir.
Where we will have a tax what? A tax savings.
Hello,
Okay.
sir. Good evening, sir.
Good evening.
This inflation rate, that is what I want to confirm. Is it 1 plus inflation rate or 100 plus inflation rate? Because if you do 1 plus,
okay.
Hello, sir. If you do 1 plus inflation rate, let's say 1 plus 5.5, now it will be 6.5. Is it 1 point?
No, it cannot be. It cannot be 6.5 Friday. 5%. What is 5%? 5% is 0.005. Is that not so?
Yes, sir.
So if you do anyhow that you know that you understand this thing, you already have 100%. Add 5 to it, or you say you have 5%. 0.05. 0.05 is equals to 1.05. Is that not so?
Okay. Yes, sir. I was thinking is that you add
Anyone,
percentage
I can decide to say I have 100%. I can say 100 plus 5 equals to 105%. I can still have 1.05. Is that not so?
Yeah. Thank you, sir. It's clear now.
Okay, that's Rejoice.
Okay, so this formula we're using for this discounting factor that we're doing for this, is it not the one like 1 all over 1 plus the rate raised to the power of n that we're using?
Rejoice, did you see raised to the power of n? Yeah. Did you see 1 divided by? Did I use 1 divided by 1 plus inflation rates? Did I use 1 divided by 1 plus inflation rates? I didn't use
No,
it.
you did.
Now I said you have 15 naira. A practical illustration. You have 15 naira, and they tell you that this 15 naira will increase by 5%. meaning that you already have the 50 naira. You need to add 5 naira to it. That is what it means. And it will be increasing on year basis. And that is the reason why I say, okay, if you check the material, I use it 1 plus inflation rate.
Okay.
Or you already have 100%. Or you already have 100%. If you have 100%, they tell you that it will increase by 5%. Add 5% to 100%. What do you have?
100. So I have the
105%.
105.
Then we still have 1.05. Then
Yeah.
every year they tell you that it is inflation per year. You follow instruction. Sometimes they will not even tell you. Sometimes they will tell you that there is a question we will still do. That the question will not even tell us to do the first year to inflate it. Maybe it will now start from the second year. So there are so many questions like that. And this question just straightforward and say per year. That is the reason why we need to pay attention to the what, most especially the part of what, the inflation part. Do you understand?
Okay, sir. Understood now. Thank you.
You're welcome.
Mhm.
Okay. So which one do we have here? So we need to also work on, should we do the working capital or the tax? Okay, let's do the one of capital allowance.
Capital. Okay.
Yeah, anyone. These are just workings, right? All these are just workings, right? So we can, anyone, right? So determination. Who is that now? Oh. So we have determination, of tax saved. Or so we have our year. I think I have to bring all these ones together, right? I have to collapse them. I think the space is too much. Okay, so we can have, oh, is this thing itself? So okay, let me just do it this way. This space, we didn't have enough space here. Okay, so we can have our items. Capital allowance, please always write it in full. CA means continuous assessment. Please don't write CA. Tax saved. Tax due. Class, what is the tax given to us? Let's check it together. The tax is being paid in arrears. Always watch. When did they pay the tax? They pay the tax in arrears. Is that not so?
Yes.
Then it is 25%. The capital allowance is 25%. Take note. Why the cost of the asset is 5 million, then the scrap value at the end of the year is 5% of the what? The initial cost. Right. So we can move and 5 million as the cost of the plants. Costs. I don't know why this. Okay. 5 million. So how many percent? What is okay? We'll get it. So the CA capital allowance. How many percent? 25%, right?
25%.
Okay, what is the 25%? This will be year one. What is the 25%?
1,250,000.
1,250,000. The capital allowance is 1,250,000. What is the tax saved? How many percent is this tax? 28%, Abby?
25%.
25%.
20%.
Percent.
20%.
20%.
20% is the tax. So what is the 20% of the capital allowance?
250,000.
250,000 naira.
250,000. Because the tax is being paid in arrears. The tax of year one will be paid in year two. Is that not so?
Yes, sir.
The tax is being paid what? In arrears. So this will have to. Okay. So we can have the tax setting down value. Tax setting down value. So what is the difference?
3,750,000.
Okay, 3,750,000. Year two. Tax written down value. Who is that? The person should mute his mic, please. Who is that? Please, you are not talking, just mute your mic. Who is that now? So the capital allowance, 25%, because it is on reducing balance method. Class. Because it is on reducing balance. But however, if the capital allowance is on straight line method, it is just the cost, right? The cost minus the square value divided by the numbers of years. Then you will now charge the tax saved on the balance. You have your cost. I will check if we have a question that has to do with a straight line where you need to determine the tax saved. They will tell you that the capital allowance, the depreciation or the capital allowance is on straight line method. The tax depreciation, the tax allowable depreciation is on straight line method. If it is on straight line, just say your cost minus the square value divided by the numbers of years. What you have, charge the tax on it. That will be all your tax savings throughout the lifespan of the asset, because it is straight line. It's the same tax savings you will have all through. So what do we have here? 25% of 3,750,000. What do we have?
937,500.
9 what?
937,500.
927,500.
937.
Okay, that's fine. So that would be the capital allowance. So this will be 937,500. So what is the 20% of 937,500?
187,500 naira.
Okay. 187,000. 187,000 what? Sorry?
500.
500. And this will be paid in year 3 because tax is being paid in arrears. The next one is, what is the tax written down value?
2,812,500.
2,812,500. Good.
2,812,500.
Yeah, 500. Yeah. So the next one is.
Now you wrote 812. It's 2 million.
Okay. We can put in 2,812. Thank you. 2,812,500. The capital allowance is 25%.
703,125.
7 what?
703,125.
703 or 13.
7003. 03125.
Oh, excuse me. 125.
Yes, sir.
So we can have 703, 125. What is the tax saved?
140,625.
140.
6 what?
625. 625.
Thank you. So this will be at year 4. So what will be the tax written down value?
2,109,375.
375. So therefore, we'll have the tax. Just a minute. Let me collapse this so that we can have space. Okay. Okay, that's fine. So the tax written down value 2,109,375. Now, class, you should not forget that if they dispose an asset at the end of the project year, you need to look for either it is balancing allowance or what, or balancing charge. And in the question, the tax, let's say the scrap value, according to the question, the scrap value says scrap value is 5% of the cost of the asset. And the cost of the asset is 5 million. Is it 5% or 10%? Let's check.
5%.
5%.
5%, sir.
Okay, 5%. That makes sense. 5%.
Which is
What do we have?
which is
250.
250,000.
250,000. So therefore, the scrap value will be 250,000. Scrap value 250,000. Now, is it balancing charge or balancing allowance?
Balancing allowance.
Balancing. You can make your mind away. Balancing allowance. So what is the difference? What do you have as balancing allowance?
1,859,375 naira.
1,859,375.
375.
So you can come here. That will be your capital allowance because you have to claim that. You make a loss on the disposal of that asset. So what is the tax saved?
371,875.
371,875. So this will be in year 5. Right? So we can, what's next? We need to adjust. Which other adjustment do we have? Working capital. Now, you can see as we are inflating all these things now. Oh, as we inflate all this, what is this answer now that we have here? We have a revenue to be 608,400. What can we call it? Since we have inflated it, what do we have there? Class.
Money cash flow.
Thank you so much. Thank you. Makes sense. That is money cash flow. See, you have to use money cost of capital to discount the money cash flow. So the next thing we need to adjust before we go is what? Is working capital, right? Working capital. Let's just finish the part of working capital, right? So what is our working capital? You need to go back and check what happened to working capital, right?
Yes.
Now let's check. Okay, who will read this part for me? Okay, in addition, quickly. In addition, what happened in addition?
In addition to the initial cost of the new machinery, initial investment in working capital of 500,000 will be required. Investment in working capital will be subject to the general rate of inflation, which is expected to be 4.7% per year.
Thank you. That is the general rate, meaning that if you need to inflate the working capital, sometime question will tell you that working capital will be 5% of revenue. Class, am I communicating? Sometime the question will tell you that, oh, your working capital will be 5% of the what? Will be 5% of your what? 5% of your revenue. So you have to go and do 5% of that revenue. We give you what? We give you your working capital, right? Meaning that the 5% of that revenue we give what? We give us what? The working capital. Class, are we still together, please? Can we move? Okay. We can move, right? So now we need to go back and structure our working capital. Working capital. Before we go, let's finish this part of working capital. So when we come back, we just need to plot on the net adjusted present value. We solve another question, right? So working capital. Okay, now let's do the working capital. Working capital as part of our workings. So these are your workings, right? Working capital. Working capital. Now, and we were told that don't forget, class, what is working capital? What is working capital? Class, what is working capital?
The money that the
assets,
entity used to commence the operation of a business.
Our resources. The money that is used for, or resources used for the daily operation or activities of an organization. Daily expenses.
Now you have a project now. You will use a working capital before you commence the project. You have a working capital which will always be at your year zero, right? You have a working capital. Or let's do it this way. Next gen professional associate. Maybe I may give next gen 100,000 or 50,000 at the beginning of this diet for working capital. If I give next gen 50,000 for working capital, they've not even commenced the diet. It will be at year zero because I've not even started anything. So when we start the lecture, maybe for the first month, we say, oh, we buy this. This is what we buy. So working capital at the beginning of the project, usually at year zero, right? Now, but we were told that it is subject to inflation. Is that not so? So let's say year one. What is the initial working capital given to us?
500,000.
500,000. So in year one, and they said it is subject to the general inflation of how many percent?
4.7%.
4.7%. We have to increase it. by that 4.7%. That is 1.047.
1.047.
Thank you. 1.047. 1.047. So what do we have here?
523,500.
500.
523.
500.
500. Don't forget that I said there are two approaches to all this. In case you check maybe one literature, then you feel this is not correct, you still arrive at the same, or you feel why did we use this method? You can ask those who are in SFM, my class, in SFM class. Whatever thing I do in class, you check Pathfinder, they may do another thing though. But guess what? I will still arrive at the same answer. But you see that there are steps. It may look complex to me, but I feel there is still more ways you can do things so that you make things easy for yourself. You don't need to cram anything. You don't need to cram figure, right? You don't need to cram anything. Just understand what you're doing. That is what I believe on. That is my philosophy. So what do we have?
548 105.
105.
548 105.
105.
So year 3 times 1.047, right, raised to the power of 3. In some cases, they will tell you that the inflation is with the working capital will increase by 5%, maybe 10% of the revenue. They will just speak one English. Just check for the 5% of the revenue and use it for your working capital. What do you have here?
573865.
573,865. Thank you. I like that energy. So times 1.047, right? So we have 3 minutes. So we'll complete this before we go. Then we'll come back at 8:30. So what do we have here?
600,837 naira.
837. 37. Okay. Thank you. So now, what you just did is for you to calculate the working capital, right? Class. You can see when you observe this thing, what happened to the working capital? The working capital is increasing. Is that not so? The working capital is increasing. Is that not so? So now, what you will do is to bring your working capital here. Is to bring your working capital. The first year is 525. The second year is 548 105. The third year 573 865. The fourth year 600 837. Now, class, this is what you are just giving me that in year 1 you spend this in year 2, but before you spend all these things, it started from one thing. I gave less than 50,000. That 50,000 will not even commence. For instance, for the purpose of this class, we've not even commenced the diet. That money will be at year 0 because we've not even started anything. Don't forget that working capital like that. At the end of the financial year, at the end of the project year, I will recoup back my money because I give you at the beginning, I will collect it back at the end of the project. So now, what you will now do is to look for what we call changes. This is how they do working capital, right? This is how they determine changes in working capital that you will use in your NPV. Changes in working capital. Now,
sorry, please, before we continue, just correct this figure. Working capital year 1, please.
What do we have?
523, 500, but you wrote 525. You have to copy that, please. Sorry. Thank you.
Okay. Okay. Thank you. So now you can see that from year 0, the working capital increased to this. Is that not so? Increased to 523, 500. Is that not so, class?
Yes, sir.
That is that not the increase?
That's the increase. The increase is 2,3,500 on 500K, 500,000.
No, okay, on 500,000. Okay. That makes sense. Okay. Okay, that makes sense. Let's do it. I forgot that there is 500,000. There is 500,000 here. Okay, there's 500,000. There's 500,000. So, what is the difference from 500,000 to 523,500? What do we have? What is the increase?
23,500.
23,500. You will put it in brackets. Is an outflow because your working capital has increased. It will reduce your, what will happen? It will reduce your what? Your cash flow, right? From 500 to 525. Now, let's check this. It increased from 523, 500 to 548, 100. What is the difference?
24,605.
24,605.
24,605. That is the increase. Now check this now. You can see that from this now, from 548 to this, it has increased. Is that not so?
Yes, sir.
It will reduce your cash flow. What do we have?
25,760.
25,760.
25,760. The first one said we have to correct that, but that's fine. Let's move on first. Can you see that from 563, anywhere you see increase, you can see that it increases. Is that not so? It will reduce your cash flow. You have to jacket it. But if it is decrease, it will increase your cash flow. You don't need to put it in brackets. So what is the difference?
26,972.
26,972. 26,972. Now, at the last project, can you see from this 600 to, you just say your 600,836 minus 0. You know, that means that your working capital did not increase after that 4 years. You still have 600,837. There's no increase in your working capital. So you cannot have 600,837. Now add all these things together. What do you have? If you add everything together, what do you have?
$100,837.
100,000.
837. 37.
Okay. Let's do it.
837.
Okay. Let's do it this way. We're supposed to arrive at that one. Let's do it this way now. Let's have 5 2 3 500. Just hold on. Okay. So if you add everything together, this, what do you have? What do you have?
6,837.
600 what?
600, 837.
It's 624,337. Yeah, but 624,337.
Okay, you
I
have
think like 600 and
837.
600.
837. 837. Good. Now, that makes sense. Now, pay attention. Oh, this is your working capital. All right. And your working capital, because what they said is that your working capital will increase. It is per year. Year 1, year 2. In addition to the initial cost of initial work investment in working capital of 5 will be required. This is what will be required. Now, that's what will be required. Investment in working capital will be subject to the general rate of inflation, meaning that you have to increase this by what? 4.7%. We've done that. But my point here is that what you need to do is that increase the working capital to have this. Now, this is year 0, right? This is year 0 before the project commences. And you see that you have 1 year. Can you see from year 0 year, you don't have anything here. But from year 0 year to this part, the working capital has increased. Is that not so? 523,500 class. Is that not so?
Yes, sir. Yes, sir.
Now, that is your increase. That is your change. Then you will now do this one. This minus this. You can see that this one also increased. This is it. You can also see that this also increased from this place. The difference is this. You can also see that this from here, it increased. This is the difference. At the end of the project, you have to recoup back all what you have spent. And that is the reason why you have it positive here. If you had everything that I've spent from year 0, I give you 523,500 in year 0. In year 1, I gave you 24. It increased to 2460. It increased to 25760. In year 3, it increased to total amount that I gave to you is what? 600,837. Of course, at the end of the project, I will just take my money down. We are good. Class, am I communicating?
Yes, sir.
Question? Question? Okay. Salut.
Good evening, sir.
Good evening.
Sir, the scrap, I don't know if it is 5% you need to calculate the scrap value.
Okay, let's check. We don't pass that side though. Okay.
Yes, I
And that
understand everything. It's just the scrap I want to know.
okay. You can describe is 5%. Do you have the material? You don't have the material, right?
Yes, sir.
That's right. That's fine. So we have
Okay.
5%. So please, when we come back, we will plot all these things in our adjusted present, adjusted present, in our net present value. You can see that working capital is interesting, right? It's interesting. Sometimes they will tell you that the working capital is 5% of revenue, 5% of this. Just do it as 5%. Then the next thing you need to do is to do changes. You see that changes in working capital, that is what you will now put in your MPP. So when we come back, we'll plot everything in our
Sir, please, before you go, just scroll down so I can screenshot and write our notes before you come back.
Before you
No,
go,
it's on YouTube already.
Go to YouTube. It's on YouTube. Oh, yeah, okay.
A quick one,
Yes,
sir.
yes.
Just, I just
So
want
I
to
will end.
Hello, sir.
You
Just
said?
before we go, so we'll not treat it to our next class. I want to just confirm something. Now, you said sometimes if they give us like our working capital should be like 5% of revenue or something. I just want to know, would the 5% be calculated on the inflated cash flow?
Yes, now it's inflated.
That's just what I was saying. Yes,
It's
thank you.
inflated. Yeah, it's inflated. Yes, it will be calculated or inflated. So Thank you so much,
Sorry,
everyone. So
sir.
we'll come back. Yeah, Tolulope.
Okay, what if we have inflation rate for working capital? We still have to calculate on
No,
revenue.
they will not say it like that. You can see that when we have inflation rate, they will not. There is no need for them to say 5% of the revenue. They can either choose one of the two.
All right.
Do you get? So when we come back, right, we'll plot everything in our net present value, so that we can solve one question more at least. This can do like 2 to 3. Yeah. So it's actually on YouTube now. So we end the.
Sorry, excuse me, sir.
Sir, please,
Can I say something?
hello, sir.
Please, can I say something?
Yes, please.
Excuse me.
Who is allowed? Am
Go
I
ahead.
allowed?
Quickly, go ahead. Is that say something now?
Okay. Please, it's the theory that is the key. You know, when we are doing this dividend, some